we're moving forward to something which is common in banking, in classical traditional banking, and same exists in the crypto and blockchain world, namely the issue and the solutions of how to safeguard as well as earn on your assets at the same time. So in the next panel, we'll be hearing about how banks can embrace crypto custody and staking as new model of safeguarding and earning. For this panel, I'm honored to welcome on stage Lorenzo Barbantini, Scanni from Colossus, Azmina Keshani from Zodia Custody, Adriano Bertini from Ledger Enterprise, Danyal Hanif from P2P, and the panel will be moderated by Olga Konchenkova, who is the chair of the Crypto Valley Association Western Switzerland chapter. Please put your hands together for an amazing panel. Enjoy.
Thank you, Benedict. So good afternoon, everyone, and welcome to our panel discussion dedicated to crypto custody and staking. Over the next 30 minutes, we'll try to discuss how banks can offer custody and staking services securely and hopefully profitably. So let's start. Well, we have a fantastic lineup of speakers today, leaders from Colossus Digital, Ledger, Zodia Custody, and P2P.org. So I'll let you introduce quickly yourself and say a couple of words about your companies.
Okay. So first of all, thank you for the invitation. My name is Lorenzo Barbantini. I'm one of the founders of Colossus. Colossus had quite a journey because we started as a validator. So we know that business quite well. And then one of our institutional customers actually asked us to execute a strategy which meant setting up a custody platform or having access to the custody platform and using assets which are staked as collateral for a hedging position. And so that exposed us to the first topic, which was, and now how do you get these assets out of custody to staking? Therefore, I say we became custodian by accident, and so we are actually also a custodian, and we're using multiple custody solutions. And basically what we've done is we've developed a solution that I will discuss later, which connects these two worlds. So the world of custodians to the world of stakers.
Okay, thank you. Adriano?
Adriano Bertini, Head of Strategy and Go-to-Market for Ledger Enterprise. How many of you know Ledger? Yes, a few of you. There is also a B2B arm. So I'm heading the strategy for the B2B arm of Ledger. There was very interesting talk before, 2 panels before this, about using external solution versus building internally. We see specialization in the crypto space when it comes to custody of assets, and we strongly believe that following the lead who specialized in the last 10 years is the right way to go, and that's why we built Ledger Enterprise. We do primarily custody technology. That's what we built. And in the last 2 years, we built an off-exchange trading solution, which is a technological solution which custodian can implement. So we're not ourselves providing that as an off-exchange. We provide the technology, and any custodian can use that. And I'm looking forward to talk about that during this panel. And thanks, CVA, for inviting me and Ledger to speak. The number of people is growing by the year, so great job.
Thank you. Azmina.
Thank you. My name is Azmina Keshani. I'm the General Counsel for Zodia Custody. Zodia Custody, I don't know if many of you know, but it's majority owned by Standard Chartered Bank. It was the brainchild from Standard Chartered Ventures about 7 years ago. And I was lucky to be there at Standard Chartered Bank at the time, where we were asked by a few innovators to create a crypto custodian, which also saw the beginning of the bank's journey into crypto and how it's developed into multiple other facets of the crypto environment. So now we have Zodia Custody operating in about 8 jurisdictions globally. Thank you.
Thank you. Danyal?
Good afternoon. My name is Danyal Hanif from P2P. I'm the product lead specifically for Ethereum, and P2P is a staking infrastructure provider. We've got around 10 billion in staked AUM, and Ethereum accounts for around 3 billion of that. So I'll keep it simple. That's it for now.
Yeah, thank you. So let's get started. Danyal, let's start maybe with you, and let's try to set the foundation. What is staking in simple words, and how banks actually can benefit from this, and how it can work as a product for banks?
Yeah, sure. I mean, it's a good starting point. So staking is the process of locking up your crypto assets for a chain in order to provide security or help the chain in one form or another, and in return you receive rewards. So for Ethereum, native staking like 3.5%, you've got Solana at 10%. There's other chains out there, but some of the key ones. Essentially, the way you could consider it is, in itself, it's a core financial product. And for any banks that want to, down the line, release products, staking is part and parcel. Unlike traditional finance, where you can release like lending products or whatever it might be, as part of crypto, staking is in its core. And I think banks definitely need like a good understanding of how staking works, the risks associated with it, and then ultimately how they can provide it to clients. Because as crypto adoption increases and you've got more and more, I guess, crypto assets being held with banks, people are going to start asking, well, how can I leverage this, or how can I get a return on what I'm holding? In traditional finance, you don't have people holding large sums of liquid cash in banks, and it's not going to be the case with crypto as well, right? So if you're getting involved in crypto custody or holding crypto assets for your clients, then it's paramount that you do get an understanding of staking. Just as an example of how it would work is, let's say you have $100 million in custody of Solana. And to keep the numbers simple, let's say you get 10% yield on that 100 million. So you're getting 10 million in rewards. And then the way the bank would generate revenue is they would get a certain percentage of the rewards. So let's say it's 10%. Obviously, there'll be splits between custodies, the bank, the infrastructure provider, but let's just say it's 10%. That's 1 million in revenue, ARR. So that's just with a 100 million example. Hopefully that makes sense. And then I think once you get an understanding of how native staking works at the base level, then there's layers to it. So you've got liquid staking tokens, you've got liquid restaking tokens, additional yield. You can involve in DeFi. But just to begin, I think staking definitely does need to be offered. One final point I'll say on that is having just a good understanding of it and being able to offer it is essentially, when it comes to new competition, it's what's going to keep existing banks trustworthy, knowledgeable, and allow clients to have faith in them. Because if they don't, or if they're late to the game and there's competitors already offering yields, then that's definitely going to be seen as a negative.
Yeah, thank you. And that brings us to the question of operational models. And Lorenzo, what do you think? What staking as a service models would make the most sense for banks nowadays?
Well, thank you for the question. So I would go back to the original model. So the first thing is that these assets are held in custody. So because banks are using custody solutions. So once you have a custody solution, then you need to work with that custody solution if that custody solution supports the asset that you want to stake. Otherwise, you're given a number of options on how you can actually complete that transaction. Because at the end of the day, you're going to be creating a transaction and you're going to be signing that transaction inside your custody platform. So in terms of models, you have you have custody platforms with already staking integrated in the native UI. Ledger and and many others are, of course, amongst these solutions. But then, of course, as the appetite for staking increases, and therefore, of course, all the custody solutions will support your basic staking tokens, and then as you get more spicy, if you want, as your appetite for more tokens gets, evolves, then you're going to be faced with the challenge of creating that transaction. That's kind of what we have done. So if I go back to what I was saying before, so that custodian by accident, whatever. So now what we do is that we have pivoted and we are in the middle between custody platforms and validators, basically enabling those transactions. Now, there's, of course, a big elephant in the room that might as well get rid of it right away, which is raw signing. And so, yes, we are using raw signing. Raw signing is the purest of ways of doing a transaction. The thing is that raw signing is also known for the retail public as blind signing. But raw signing doesn't need to be blind. And therefore, at least in our model, what we do is that we enable those transactions in a clear, verifiable way. What does that mean? I'm going to get a bit technical. I'm sure Adriano is definitely, he knows that I'm an immigrant in the technical, in the technical space, but I'm also a heavy user. And therefore, what you do is we do, first of all, multi-party crafting. So more than one user is crafting the transaction. When the transaction gets recomposed, you want to be sure that it's the same transaction. If it's not, the transaction will fail. Then you have something that we've designed, which is a transaction length that gives you the clear transaction, the JSON file, which basically just tells you what you're doing. You're staking from A to validator B. This is the gas fee or whatever else is involved. And so these components, so the multi-party crafting and the transaction length, which gives you a complete view of the transaction, coupled with another decoder, which is kept offline so that nothing and nobody can tamper with, with any libraries, will give you the same result. So one more thing, and I'll stop on this technical part, but the hash is a one-way function. From a transaction, you can get to the hash. You cannot get from the hash to the transaction. So once this is clear, it means that if you have two hashes which are the same, you know that you're doing the transaction which you were intended to make. So all of this is how we see how staking should be done, and therefore what basically we offer to banks and to custody partners is the connection to our platform, and we enable many to many, because as things evolve, there are certain customers that are going to have multiple custody solutions, and they're going to have, of course, multiple validators. If you want to do that, you need a middle platform that is going to allow you to do that. So that's our approach to this topic.
Okay, thank you. And let's now maybe zoom out a bit and take a look from regulatory perspective. And to maybe, Azmina, if you can tell a little bit more on how the different jurisdictions, they treat and approach crypto custody and staking, and what are the best practices that banks can actually implement in order to be compliant.
Thanks, Olga, for that question. So that's quite a big question, so I'll try to simplify it for the audience. So what we've seen over the last few years, and there's been an acceleration in the last year in particular, in crypto asset regulations coming into force in most jurisdictions around the world. What that means is that we're going from an AML or anti-money laundering registration process to a licensing process. And this is something that banks are familiar with and very comfortable with, because they'll be licensed in the jurisdictions in which they operate. And so what they need to think about when they go for their license permission for crypto asset services, whether it be staking, custody, or anything else, they will have to apply for what we call a variation of permissions. So they most likely will not need a brand new license, but what that comes with is a presentation to the regulator with expertise. So they need to demonstrate that they have the right expertise. They have to demonstrate that they have the right operational risk frameworks and controls, and have thought about the cybersecurity risk and are able to present for any future risks. So that's pretty much where the banks will be. And as you've heard, a lot of the banks are already getting into this space. So that a lot of them, I think it was in the last presentation, it was Clearstream has already got its permission in Germany. So we're seeing that happening now. So that's why you'll see like the jump for them relatively easy in that respect. The second thing that they are looking at are prudential regulations, and this, frankly, might be a little bit of a hindrance or something that will slow them down. So under the Basel requirements, they all have to have limited exposure to crypto assets. So in total, 2% of their balance sheet, but you can imagine banks have huge balance sheets, so it's still quite a lot, but it's limited to 2% of their balance sheet. So that's something that they're all thinking about. Although the Basel requirements are delayed somewhat in most jurisdictions. I think in the UK, it's been delayed by a year. The US has said they're not ready, so there are some things like that to be talking about. So the last thing I'll deal with is staking. So when you're looking at staking, there's really just three things to look at and to think about when you're presenting your solution to the regulator. One is, where are the assets? Are the assets staying in the wallet, or are the assets on the smart contract? What is the solution, and can you explain that to the regulator? The second thing, which is quite important, is the asset collective investment scheme. So if it's a collective investment scheme, it becomes a security. So it becomes a different dynamic. Some regulators have clarified that it's not a collective investment scheme. So that's quite important, and it helps with the driving of innovation in this field. So those are the sort of high-level run-around of the
And I believe there is no harmony in all regulation across the world?
No, there is not, but there's no harmony in any regulation around the world, so it's the same.
Okay, thank you. And let's now get a bit practical now and see what does full custody look like, actually. So, Lorenzo, Adriano, sorry, I have a question to you about about other services that can be included in custody and maybe based on Ledger example.
Within the Ledger platform.
Yeah.
So we have taken a very simple approach, right? So Azmina was talking about all the regulatory concern, right? And I think it comes down to one main concern, which is preservation of assets, right? And we strongly believe that the biggest risk that we have in the market right now is counterparty risk. That is what is actually locking collateral and is locking liquidity from the market. We estimate to be 20 to 30%. So we think that most of it comes from security concern. You look at the last Bybit hack, you look at the last FTX debacle, and there's a graveyard. And I think if you sum it up, it's double-digit billion, the amount of assets that have been lost, mismanaged, displaced. So at the core of our industry, we have digital asset security. We stand as the longest firm in the industry. For that reason, we put security first. So Lorenzo before explained, his stance about row signing and everything else. Where Ledger stands in terms of anything related to security is the most extreme side. We do not want to compromise on security ever, okay? So we do it with two products, primarily. We have multiple products, but two are the flagship product. One is Ledger Enterprise Solution, which is our custody solution. And we sell it as a custody technology. So we're not ourselves a custodian. We have custodian from 50 million up to billions in assets. And we secure that. How do we do that? Multiple features, but primarily governance, software, with authorization on hardware. We are HSM based. Two, personal security device, our stacks. And we'll talk later why this is really relevant. And three, basically the ability of the client to interface with the HSM through the personal security device. So those are the three components that make Ledger Enterprise custody technology. Then there is the off-exchange solution. The off-exchange solution is very recent. We started the conceptualization of the design 2 years ago. And in the last few months, we deployed to production. And now we have the initial test rates from asset manager with some of the custodians client that we have. Why are we doing off-exchange? And for people that don't know, off-exchange means you are placing assets on a collateral account, and an exchange provides you liquidity at the exchange with the guarantee of those assets being pledged in collateral. So now you have an additional problem, and that's the reason why we built TradeLink. Now you need to preserve the collateral assets. And there are two elements. One we already know, which is the custody of the assets, which we already taken care of. But second is the intent of the asset manager and the intent of the exchange. those two intents needs to be preserved with the same level of security. And we are the only one in the market that provide cryptographic proof of the intent, which means that if the custodian will disappear and ledger will disappear, you still have the signing of that collateral pledging request. And currently, we are the only one providing that, and we're the only one that provide that on a secure screen. So that's, in a nutshell, what we do. I know there are a lot of questions, but maybe we'll take it afterwards.
Yeah, thank you. And as you also touched the question on security issues and Bybit case, so let's maybe stay with you, and maybe if you can comment on this case and what banks can learn from this.
Yeah. So I've been around for a while, so I use like old adage, and the old adage is don't trust, verify. That is the simple answer. So you want to prevent that, don't trust, verify. And don't trust for people means different thing. For us, it means don't trust anything that is not a personal security device that is secure, and we trust only Ledger, right? Obviously. And the reason is that we have, not because we are complacent or anything, just the opposite, because we have a dedicated team called the Donjon, which is a security specialist team that does uniquely research on vulnerabilities. And once we find vulnerabilities, we patch it on our devices or software. And we do the same for the entire industry. So we do that on all other devices. We are the only one that I know in the industry that does that at scale. For what pertains to details of Bybit or in general on securing the assets and what could be the way you can prevent that, I think there are, again, 3 ways. The first one is using a personal security device that is secure. Never, ever trust any other screens, meaning the computer screens. And I'm sorry to say, because there are a lot of solutions out there that do use cell phones or mobile phone screens. I mean, it's very difficult to penetrate, but it's not impossible, right? I mean, it's not impossible even here, but the level of security that we have here is far more advanced than on your mobile phone. And unfortunately, there are a lot of solutions out there that use mobile phone. So this is one, like secure screen and secure device. 2 is clear signing. And we are the only one, again, in the industry that provides that. Clear sign fall on the opposite spectrum completely of anything else that was discussed and everything else related with signing, meaning it is the most secure way. Clear signing means, as Lorenzo explained, once you have the hash, now we know what that hash means, and we display to you the content of that smart contract. We display to you the content of that transaction. Now, we are going a step ahead. We're actually going to work on simulating transactions, so you know what's going to happen once you do that. So we're working toward an even more secure way. But if you use Ledger device, and if you use clear signing, you have the highest level of security that you can have against those type of hacking. The third one, and is uniquely Ledger Enterprise, is having governance framework and governance rules engine, like we do in Ledger Enterprise, secured by hardware again. So we have an HSM-based solution. So every authorization, well, first of all, the authorization are defined, again, through the HSM. So if you are giving rights to create a transaction or approve a transaction, needs to be approved on a hardware device, which speaks directly with the HSM. Once this is done, which is the administration, you have the operation, and the operation is the same. Everything needs to go through the personal security device and the HSM. Now, we do offer API, and obviously we do that securely. So you can do programmatically similar things, but if you want to be the most secure, we offer that. Those are the 3 ways, so effectively using Ledger Enterprise, to prevent what happened to Bybit and to prevent similar occurrences as we have seen in the last few years.
Thank you. Azmina, and from regulatory perspective, what are the key takeaways for banks from Bybit case?
So I'll just be very brief here, but I mean, I think what's very interesting in relation to Bybit is that all of our institutional clients have already been sitting around analyzing this because they've been asked by the regulators, how are you dealing with this, and is this a risk to you? Given that a number of our clients are not mass users of crypto, they're analyzing the hack risk and looking at it across their entire payment systems. So there's learnings in relation to that. So I think it's important to know that the regulators are actually very well educated on this subject, and they fully understand, in particular because this is a third hack of exactly the same type by the Lazarus project. The Bybit hack was the largest hack, so that's quite important. And I think what the regulators would probably be looking at are things that the banks called operational risk controls framework. So things like, for example, it's unlikely that a bank would have a 1.5 billion concentration risk in one spot, right? That's available for everyone to see online. That would have been picked up by risks and controls and ensure that that would never have happened. So I think, in fact, the banks are probably a lot more prepared than you think, and they're probably gearing up to be able to deal with that when they have to present to the regulators.
Thank you. Yeah, you want to add something, Adriano?
Yeah, no, we're very looking forward, to regulation that's also on the security front, because, obviously there are multiple discussions around that, but if you tackle that from the technology perspective, and there was discussion again before in 2 panels ago, before ours, where they were saying, should we use like a specialized provider of security, or we should build internally, right? So even if you build internally, you should have some standards. So we're looking, for collaboration with regulators to build that standard.
Yeah. Lorenzo, I know that Colossus also done some internal research and investigation on Bybit case. Do you have anything to add?
Well, I mean, very little to what was already said by my colleagues, but yeah, it's basically understanding what you're doing. Because the real issue is that if you're not checking, and so Adriano said it before, so verify, don't trust. So if you're verifying, it means that you know what you're doing and you know what the expected result is. If the expected result is anything but what it's supposed to be, there is a problem. And so the simulation, which is something that also we are doing, there's products that will do it for you. Of course, then it's a product and it's something else that can be tampered with. So everything that you touch needs to be in a secure environment. And so, if you do a simulation and that simulation engine is hacked, then you have another problem. But regardless, you need to have multiple sources. The multiple sources need to be secured. And the operator that is doing that transaction needs to have a clear path and needs to know what the result is. And that's all about education, and that's about explaining to people what you're doing. Before, we never said it, but we're actually talking about either delegated proof of stake or proof of stake, which we didn't say, but in the delegated proof of stake, assets are not moving. And so, for example, using the Ledger enterprise solution, you can do very interesting trades where the assets don't leave the bank, so the assets stay in the bank, and you get leverage, you can do staking, you can do products around this. But it all requires the operators to know what they're doing and to be, to be skilled for this to happen. Because, unfortunately, reading the Bybit hack, it seemed like that somebody was kind of, not a lot of attention was given there, to say the least.
Yeah, thank you. So, and to close this loop, Danyal, let's go back to staking economics. So how actually banks can balance potential staking rewards and the risks associated with the managing of crypto assets?
Yeah, we're short on time, so I won't keep the answer too long. But it's essentially the first step is the banks need to make a decision on the fact that they are going to offer a certain product, and let's start with staking. So that's step one, right? And then you get into the specifics of what architecture and then what security implementations you need to make. And security needs to be at the core of everything, right? So what banks are doing today, the products they're releasing, the financial instruments they're releasing to enable their customers to access financial products that they want to access, it's the same thing, but with a different asset, right? Yeah, banks would still want to create the same financial products, the same yield opportunities for their clients. But once that decision is made, that this is a real thing and we want to move forward with it, that's when you get into the specifics of like the complexity of the architecture or how you approach that. But I think the decision needs to be made first. And there's some extremely good solutions, existing solutions on the market, from like Zodia, you've got Ledger and Colossus, all of them help you to ultimately achieve that full user flow.
Okay, thank you. And I believe we're run out of time. Thank you to our panelists, and thank you to being here.
Thank you very much.
And enjoy the rest of the event. Thank you.